The efficient markets hypothesis, or EMH, has been the dominant framework for understanding financial markets for decades. The EMH posits that market prices fully reflect all available information, making it impossible for investors to outperform the market consistently. However, recent events such as the GameStop short squeeze in 2021, the COVID-19 market crash and recovery in 2020, and the rotation between value and growth stocks in the wake of the pandemic have called into question the assumptions of the EMH. In response, an alternative framework known as the Adaptive Markets Hypothesis, AMH, has gained traction. Proposed by Andrew Lo in 2004, the AMH integrates insights from behavioral finance, evolutionary biology, and complex systems theory to provide a more nuanced understanding of market dynamics. This video will explore the key tenets of the AMH and illustrate its relevance for investment analysts using these recent real-world examples. The AMH recognizes that investors are not always perfectly rational, as assumed by the EMH. Instead, investors exhibit bounded rationality, making decisions based on heuristics and biases. This can lead to market inefficiencies and mispricings, as exemplified by the GameStop short squeeze in early 2021. Retail investors, coordinating through social media platforms like Reddit, drove up the stock price of the struggling video game retailer, forcing short sellers to cover their positions at significant losses. This event highlights the power of non-rational behavior in driving market dynamics and creating opportunities for savvy investors who can identify and exploit these inefficiencies. Under the AMH, market efficiency is not a binary state, but a continuum that varies over time and across markets. Periods of high efficiency can alternate with periods of inefficiency, creating opportunities for skilled investors to outperform. The rapid market crash in March 2020 in response to the COVID-19 pandemic, followed by an equally swift recovery, illustrates the cyclical nature of market efficiency. The initial panic selling and subsequent rebound suggest that markets can oscillate between periods of inefficiency and efficiency as new information is processed and investor sentiment shifts. Investment analysts who recognize this cyclical pattern can position their portfolios to capitalize on these shifts. The AMH views financial markets as complex adaptive systems, where market participants adapt and evolve over time. Successful strategies are copied and propagated, while unsuccessful ones are abandoned, similar to the process of natural selection in biological systems. The rotation between value and growth stocks in the wake of the pandemic showcases these evolutionary dynamics in action. As the economic landscape changed, investors adapted their strategies, shifting from high-growth tech stocks to more cyclical value stocks. This demonstrates how market participants evolve and adapt to new information and changing conditions. Investment analysts who understand these evolutionary dynamics can anticipate and adapt to these shifts in market sentiment. The AMH offers several important implications for investment analysts. First, it suggests that there may be opportunities for skilled active managers to outperform the market by exploiting temporary inefficiencies, such as those observed during the GameStop short squeeze. Second, the cyclical nature of market efficiency, highlighted by the COVID-19 crash and recovery, underscores the importance of managing risk in a complex and dynamic market environment. Investment analysts should incorporate techniques like scenario analysis and stress testing to assess portfolio resilience under different market conditions. Third, the evolutionary dynamics illustrated by the value growth stock rotation emphasize the need for investment strategies to adapt and evolve over time. Investment analysts should regularly review and adjust their models and assumptions to account for changing market conditions and new information. Finally, given the role of bounded rationality and emotion in driving market dynamics, investment analysts should seek to understand and analyze investor behavior, incorporating insights from behavioral finance to identify potential mispricings and contrarian opportunities. The adaptive markets hypothesis offers a compelling alternative to the efficient markets hypothesis, providing a more realistic and dynamic framework for understanding financial markets. The recent examples of the GameStop short squeeze, the COVID-19 market crash and recovery, and the value growth stock rotation demonstrate the power of the AMH in explaining complex market phenomena and guiding investment decision-making. By recognizing the role of bounded rationality, cyclical efficiency, evolutionary dynamics, and emotion, The EMH equips investment analysts with a powerful lens through which to analyze market behavior. By embracing the principles of the EMH and adapting their strategies accordingly, investment analysts can navigate the ever-changing landscape of financial markets with greater skill and resilience.